The history of money. Have you ever stopped to think about how money came to be? It seems like it's always been around, those crisp bills or the tap of your credit card. However, that's not the truth. There is something fascinating and surprising about the journey of money throughout human history. Today, we're going on a time-traveling adventure to explore the history of money, from the very first forms of exchange to the digital wallets we use to trade. So, let's start it. The barter system before 6000 BC. Our journey begins way back in time, before the invention of money. Instead of swiping plastic or handing over bills, people relied on bartering, a system of direct exchange. You might offer a basket of juicy berries to your neighbor in exchange for the durable wooden tool he crafted. This method worked well in small communities where everyone knew each other's needs and skills. The baker knew the farmer needed bread, and the farmer knew the baker needed fresh eggs. Transactions were simple and based on mutual benefit. However, bartering had its limitations. What if the person you wanted something from didn't need what you had to offer? Imagine trying to trade a freshly caught fish for a new pair of sandals. Bartering also became complicated as societies grew and people specialized in different professions. A farmer with plenty of wheat couldn't easily trade it for a single well-made axe from the village blacksmith. Barter couldn't efficiently represent the varying values of goods and services, making trade more complex and hindering economic growth. Commodity money, 6000 BC to 300 AD. People eventually started using commodity money, objects with intrinsic value that everyone agreed could be used for exchange. These objects were often chosen because they were durable. They wouldn't rot, break easily, or lose their value over time. Portable, you could carry them around without too much trouble. Divisible, you could easily break them into smaller pieces for smaller transactions. Examples of commodity money included seashells. Used in many coastal communities, they were beautiful, durable, and relatively rare, making them valuable for exchange. Salt, a valuable commodity used for food preservation. It was easily transportable and divisible, allowing for smaller transactions. Livestock. Animals like cows or sheep were valuable assets that could be traded for a variety of goods. While commodity money solved some of bartering's problems, it still had drawbacks. Imagine carrying around a sack of salt to buy some pottery. It wasn't always practical for everyday transactions. The rise of coins, 600 BC to present. Around 600 BC, a revolutionary invention emerged that forever transformed commerce: coins. Imagine the convenience of carrying a small pouch filled with lightweight coins instead of bulky sacks of salt or herds of cattle. Coins, typically made from precious metals like gold and silver, offered several advantages over commodity money. Standardization was a key feature. Each coin had a guaranteed weight and value stamped on its surface, eliminating the need to weigh or haggle over its worth during transactions. This made trade much faster and more efficient. Additionally, gold and silver were highly durable, resisting rust and decay, ensuring they held their value over long periods. This stability and value offered greater confidence to buyers and sellers. Another significant advantage was divisibility. Unlike a sack of salt or a cow, coins could be minted in various denominations to represent different values. This allowed for more precise transactions, facilitating the purchase of both expensive and inexpensive goods. Imagine using a single, smaller coin to buy some fruit instead of having to trade an entire cow. The flexibility provided by denominations made coins significantly more practical for everyday use. The Lydians, an ancient civilization in present-day Turkey, are credited with creating the first standardized coins around 600 BC. The widespread adoption of coins by other cultures soon followed. This innovation greatly stimulated trade, both locally and over long distances. With the ease and efficiency coins offered, commerce flourished, contributing to the growth of economies around the world. Paper money, 11th century AD, present. Coins had limitations, such as being heavy and risky to transport in large amounts. To address this, paper money emerged in 11th century China as a promissory note backed by gold or silver. Lightweight and easier to carry, paper money simplified trade and reduced theft risks. It also allowed governments to regulate economies more efficiently. However, its acceptance relied on trust in the issuer's ability to redeem its value, a principle that evolved into modern electronic currencies. The Islamic Golden Age. Muslim scholars pioneered financial tools like credit, checks, and promissory notes, establishing innovative banking systems. These advancements fostered a dynamic economic environment during this period. Indian subcontinent. India's currency history includes the rupee, introduced by Sher Shah Suri in the 16th century. Coins were in use as early as the 3rd century BC, making India a leader in early monetary systems. Tallies in 12th century England. England used wooden tallies as a symbolic currency, initially for tax receipts. Over time, they evolved into public IOUs, demonstrating trust in the monarchy. Goldsmith bankers and early banknotes 1450197 Goldsmiths in England stored gold and issued promissory notes backed by deposits, marking the birth of fractional reserve banking. These notes paved the way for modern paper currency. First European banknotes, 1661. Sweden's Stockholm's Banco introduced banknotes in 1661, replacing bulky copper plates. Though the bank failed, the idea persisted, influencing stable banking systems in England and Scotland. The digital age, 1960s present. Digital payments, including credit cards and mobile wallets, revolutionized money management. Transactions became quicker and safer, though technology dependence and security risks remain challenges. The future of money. Cryptocurrencies, secured by cryptography and independent of central banks, may redefine money. However, as a new concept, they carry inherent risks and require careful consideration. From bartering to digital wallets, the history of money highlights humanity's innovation. What do you think about the future of money? Share your thoughts in the comments. Like, share, and subscribe for more insightful content. Thanks for watching.